Hello everyone. We are going to present liquidity risk of Citi Bank. Myself Ritwik Mohanty and my group partner Sanjay Sharma of IFIM B School Bangalore. Citibank, a major international bank, is the consumer banking arm of financial services giant Citigroup. Citibank was founded in 1812 as the Citibank of New York, later First National Citibank of New York. As of March 2010, Citigroup is the third largest bank holding company in United States by total assets after Bank of America and JP Morgan Chase. In 1863, the bank joined the US new national banking system and became the National City Bank of New York. Citi has retail banking operations in more than 100 countries, claiming about 15 million users. The fundamental of liquidity risk, the risk stemming from the lack of marketability of an investment that cannot be bought or sold quickly enough to prevent a minimized loss. In finance, liquidity risk is the risk that a given security or asset cannot be traded quickly enough in the market to prevent a loss, make the required profit. A major risk a bank runs is liquidity risk. Banks must honor their commitments by making sure that there is enough liquidity to meet funding requirements. Now coming to liquidity. It refers to invest in liquid assets than illiquid ones because it is easier for an investor to get his or her money out of the investment. Examples of assets that are easily converted into cash include blue chip and money market securities. Let us put some light on various components of liquidity of a bank. A bank has three components. One is visualization, mobilization and optimization. Now coming to visualization. Visualization is about treasurer's ability to access all cash flows. Mobilization is about treasurer's ability to consolidate excess cash at the right place. Optimization is about risk adjustment return on excess cash. Liquidity risk can be measured through a ratio that short-term security divided by deposits. The higher value will get is the lesser the risk, and the lesser value will get the higher the risk. Citibank liquidity has two components, liquidity buffer and funding components. Liquidity buffer defined as maintaining of ample cash flows and readily marketable highly securities on hand to meet short-term funding operations. What are the funding components? Largely use cost-effective deposits to fund both liquid assets and loans. Supplements that funding of bank equities, the long-term secured debt and equity. As per Basel III, highly liquid assets held by financial institutions in order to meet short-term obligations. The liquidity coverage ratio is designed to ensure that financial institutions have the necessary asset on hand to ride out short-term liquidity disruptions. Banks are required to hold an amount of highly liquid assets such as cash or treasury bonds equal to greater than their net cash over 30-day period. The liquidity coverage ratio started to be regulated and measured in 2011, but the full 100% minimum won't be enforced until 2015. The Basel liquidity coverage ratio is designed to ensure banks maintain an adequate level of unencumbered cash and highly liquid securities that can be converted to cash to meet liquidity needs. Meeting these requirements could have significant balance sheet repositioning cost for those banks not in compliance. Citi believes it will be able to avoid any such repositioning cost given its current estimated Basel III ratio. The liquidity coverage ratio is an important part of the Basel Accords, as they define how much liquid assets have to be held by financial institutions. Because banks are required to hold a certain level of highly liquid assets, they are less able to lend out short-term debt. Now coming to the liquidity coverage ratio of Citibank. Citibank has its liquidity coverage ratio is 125%. As per Basel III requirements, it's only 100% and industry averages it's tend to be less than 100%, but the Citibank has the highest liquidity coverage ratio, which is 120%. Next slides will be continued by my partner Sanjay Sharma.
Hello everyone, my name is Sanjay and I am going to explain about the liquidity of Citibank. As my friend Ritwik has explained about various parameters of liquidity about Citibank in theoretical, I'll be going to tell something more about the analysis part. First, the liquidity has major characteristic, that is the assets which are marketable, divisible, revisable, and it can able to create the capital. That assets are known as liquid assets. And the liquidity resources in Citibank as a percentage of total asset, in the graph we can see that in 2011 it's 19%, and 2012 Q1 it able to achieve 18%, and 2010 it's 17%. As you can see, it is going on increasing, and it is a good sign for the Citibank. Now coming to the structural liquidity of the Citibank. First of all, what is structural liquidity? It is the long-term liquidity metric introduced by Basel III framework that calculates the proportion of long-term assets which are funded by stable long-term funding. Structural liquidity ratio should be higher than 100%. As we can see, it has a good record on deposit and long-term debt as well as in equity. We can see the deposit in the green color bar. It is having a good significance, and it is a good sign for the Citibank. Coming to the crisis that happened with Citibank in the year 2008, it was a very huge crisis. It was a very huge crisis for the Citibank in the year 2008, and despite of the huge liquidity crisis, Citibank able to survive very perfectly with the crisis, and Citi has currently liquidity coverage ratio of 125% as well as Tier 1 common ratio of 11.6% and Tier 1 capital ratio of 13.6%. How Citi measures the liquidity risk? There are certain ways to measure the liquidity risk. It includes liquidity ratio, stress testing, and liquidity limit, and it internally uses the cash capital to measure and monitor its ability to fund the structurally illiquid proportion of balance sheet on specific product by product basis. Coming to credit rating to the Citibank liquidity, the Standard & Poor, which is a very well known company, on November 29, 2011, it has assigned A to Citibank as it shows that it has a strong business position, adequate capital and earning, moderate risk position, average funding, and adequate liquidity. Coming to conclusion, at the end of first quarter, Citi has $462 billion in cash and available for sale of securities, which represents that it is a highly liquid asset and which consists of 25% of the balance sheet. It has a ample liquidity based on variety of stress test and liquidity model. And as per the Basel III, which is coming to implement until 2015, it is able to meet all its criteria according to Basel III, and it is trying its best to get the norms of Basel III. It has the LCR estimates to be excess of 125%, which is comfortably above proposed requirement. Thank you very much.